Finally, we now come to part 4. I don't know if it's part 4 or part 5, but it's a statement of cash flows, which is really important if you're going to study finance. Remember, accountants are going to mostly be concerned with what they have to report to the IRS and presenting clean financial statements, which is the income balance sheet, the income statement, retained earnings is part of that. And that's very important because you do not want to make a mistake on your, or intentionally make a mistake on any of your financial statements, because that could carry civil and criminal penalties, as we know. And we're going to go over it, my last piece, where I go over the qualitative aspects of accounting or these particular financial statements. But the statement of cash flow is a little different because it's what the finance people are interested in. It's how much cash is actually in my pocket. Like, for instance, if you're writing a check for your mortgage every month of, say, $2,500, and that's the check you write to the mortgage company. Well, one way to look at it, most people will probably look at it as, well, it cost me $2,500 to live in this house. But here's the reality. If you're getting a deduction on your taxes and on your, which you do, on your taxes and your mortgage, depending on what state you're in, your income level, if you're getting that, because now we know with the new tax law you can get a high standard deduction, but let's assume you're writing off your mortgage and your real estate taxes. Well, just like going back to my depreciation video, you're getting a break from the government. You're taking income out of your IRS statement or out of your IRS filing, so you pay less taxes. In effect, if I'm paying less taxes, whatever my tax rate is the share that the government is kind of giving me a shield on. So if I had $20,000 of mortgage payments in a particular year, my tax rate's 30%. Effectively, I've saved 20,000 times 0.3, which is $6,000, because I didn't have to claim it. So try to understand that. Spend some time thinking about that, because it's really important. So if I'm able to shield 6,000 of my income, effectively the government picked up 6,000 because I would have had to write them a check for that. So your effective cash flow is increased at the end of the year by $6,000 is what I'm trying to say. When you get those refunds from the IRS, these aren't gifts from the government. They're just giving you back the money that you didn't take advantage of during the year. If you had taken your full deductions, you wouldn't get any money back. Remember, anything you pay into the tax system, if you get it back, that means you overpaid. That's all it means. When people get these tax returns back and they feel like they got some sort of bonus check, it's not a bonus check. I mean, get this straight. You gave too much money during the year, which is fine because you don't want to owe money. Don't get me wrong. You definitely do not want to owe money. So it's always a smart thing to maybe overpay and get a check at the end, because you don't want to find out, you wake up and you find out you got to write a big check to the IRS. That's not good either. That's not what I'm implying here. But what I am telling you is when you get that money back, it's the money that you shielded. So if you get money back because you had mortgage deductions, well, that's great, but that's cash flow that comes back to you because effectively you had it taken out of your check prematurely or over. But that's fine. But just understand what that number is. And that's really like the statement of cash flows. So here we know that 231,000 is the net profit that we had from our income statement, right? Here it is. And 239,000 is the depreciation write-off. And remember, go back. Now I want you to go back. And if that doesn't make sense to you, I want you to review my video on depreciation so you understand that. What I'm going to do now is add back the depreciation. Just like I explained how you would add back the mortgage money that you didn't, the deduction that you were able to take on your taxes and you got a refund. So that's what you're doing. You're adding back a non-cash expense. It's really important to stop there and think about it. Pause the video. Go back to my depreciation video and think about it. You are adding back a non-cash expense, something you were able to deduct from your taxes so you didn't pay as high tax. Depreciation is no different than your mortgage and real estate taxes. So take a minute, or if you own a business, write-offs. Take a minute and think about it because this is really important. Okay, so we're adding that back. And then if we offered more credit to our customers in this particular year, well, it would be a negative because effectively we've used our cash to make sales and that comes out of our cash flow. So that's why we reduce our statement of cash flows when we increase our accounts receivable. If we had decreased our accounts receivable, it would be a positive because we're lending less money. In this particular year, we use less inventory. So if we were whatever business we're in, auto dealer, computers, whatever, we carried less inventory. Well, if we carried less inventory, we needed less cash. So in this case, since we decreased our inventories, we added back our cash flow. If we had increased our inventories, obviously, we would subtract. Now, again, in this particular year, we borrowed less money on a short-term basis from our suppliers. Our accounts payable is basically the accounts receivable from the other side. Whatever we use that particular year, raw materials, basically probably raw materials in this business. Well, we had people who supplied us with those raw materials, and they loaned us the money to buy them. Effectively, they gave us terms. We wouldn't have to pay. Remember I tell you about ShopRite. They sell the product that day and get cash, but they don't have to pay for things for 60 days, and that's how they make their cash flow. Well, here, since we increased it, we will add it to our cash flow. So these are two sides of the same coin, basically. We gave more credit to our customers, so we subtracted. We took more credit from our suppliers, so we added it. And then, if we had prepaid more expenses, remember I talked about accruals early on. If we that's why you got to watch these videos sequentially. If we prepaid our expenses, well, then it would be an addition. And so we would increase our accruals. So when we net all these things out, once again, I sum them up here so you're not a little kind of free tutorial on Excel. I'm going to come up with the cash provided by our operating activities, which of these is 500. Now, in this particular year, we increased our gross fixed assets. What does that mean? We either enhanced our buildings. Let's say we were in a school and we put new technology in, or we built a new building, or we put in a new parking lot, or whatever we did. We bought a new series of trucks, a fleet of trucks. If we did all those things, that's money we had to spend to keep our business going. It's a capital expenditure. That's why when you watch economics and I always tell you, read the papers, and you see the capital the capital spending index. It's an important number because it tells us how much money companies are devoting to things that make other things, capital spending. And if they expect business to go up, they're going to increase their capital spending. In this case, this business obviously feels they're going to do more business. So they enhanced their building, they bought a new building, they increased, maybe they bought trucks. When they did that, they had to lay cash out. Now, that's an investment in the future. Obviously, they'll be able to depreciate those things at one point. But right now, it's money they spent this year, so we're going to subtract it. So take a minute, pause this, think about it. So we take that out, and finally, we have our financing activities, and that's the third part. So we paid off some of our loans. Think of it like when you pay off your credit card. So basically, if we paid off some of our loans, we had to lay cash out. So that came out of our pocket. Think about it like I've been paying off my credit cards or some sort of card debt that I had. Well, I would decrease my notes payable. But on the same token, I took out a long-term loan. Maybe I took out a longer car lease. Well, this would be the payment of the old lease. This would be, I increased my debt. So actually, I brought more cash in because I bring in more cash in when I take on more debt, but I paid off some of my old debt. And then I have 11,000 more in stockholder equity. I must have sold some stock during the year. That's what happened here. So I brought cash in by bringing in new partners effectively. I brought in new partners. And then remember from our list, retained earnings and income statement, I paid out dividends. So preferred of 10, and I think it was 98 on common. So that had to come out of my final payout. So when I net these out, that's my cash provided by financing activities. So when I add this, well, I subtract actually, and this, and what I did was I did an add because I made these negatives. It's again another little free Excel tutorial. I'm coming out with 92,000. So that's my statement of cash flows. In this particular year, I brought 92,000 positive into my account. What I would do with this is I would spend a lot of time thinking about it, going through each thing, thinking about the concept, maybe related to your own personal business or your own personal financing, because this all relates. And any company, once again, as small as your local company, and as like a local restaurant or hairstylist, and as large as IBM and Apple and Nestle's, they all have statements of cash flows. It's just much larger numbers, but it's all the same concept. So that kind of wraps this up. The first part is the income statement and balance sheet. Then we talked about retained earnings. Then we talked about statement of cash flows. What I would tell you is if you want a copy of my interactive spreadsheet, which would help you better understand it, please leave your email in the comments, and I will do that. If you're one of my students, obviously, just send me a note. Great Great talking to you. Love doing this. Love making people learn more. Thank you.